Hey guys, welcome to this Ready Set Crypto video. We just hit 50,000 subscribers, so thank you to everyone who subscribed and all the fantastic words of encouragement. I love doing this stuff. I love helping you guys. It's such a privilege to be able to make these videos for you guys, and I'm honored to be able to share my work with you. As you might have seen, we opened up the premium newsletter last week and the response has been so great. Thank you to everyone who signed up and is supporting the channel. This is what we wanted to do instead of having something like a Patreon. We wanted to leverage our expertise. Me being in crypto every day and Doc being a 20-year veteran of stocks and options trading, we wanted to bring you the very best we can, show you what we're doing and how we're looking at the markets. Because we absolutely want to continue to grow this channel and expand the community of people who appreciate high quality crypto analysis like you. All right, so let's talk about cryptocurrency and why they have value that continues to rise. Now, this causes some disagreement because everyone has an opinion on this, so I'll try to be as objective as possible. One of the best ways to do this is to compare against existing assets, existing paradigms. Precious metals have long been valued for their scarcity and aesthetic appeal, even though as metals, most are largely inferior to more common metals. Their malleability makes them impossible to use for structural support as they can easily be deformed. However, due to their scarcity and now near universal acceptance as a form of beauty, they have come to be considered as a relatively safe store of value. Notice this figure reveals that gold supply is on an inflationary schedule. In other words, each year more gold is pulled out of the ground than the year before. I'm sure much to the surprise of many who hodl gold. Crypto assets, like gold, are often constructed to be scarce in their supply. Many will be even more scarce than gold and other precious metals. For example, Bitcoin, digital gold, is about 10 times as scarce as gold itself. The supply schedule of crypto assets typically is metered mathematically and set in code at the genesis of the underlying protocol or distributed application. Bitcoin provides for a maximum of 21 million units by 2140, and it gets there by cutting the rate of supply inflation every 4 years. Currently, the supply schedule is at 4% annually, and in 2020, that will be cut to 2% annually, and in 2024, it will drop to 1% annually. Satoshi, the creator of Bitcoin, crafted the system this way because he needed initially to bootstrap support for Bitcoin, which he did by issuing large amounts of the coin to the earliest contributors. As Bitcoin matured, the value of its native asset appreciated, which means less Bitcoin had to be issued to continue to motivate people to contribute. It's a domino effect. Now that Bitcoin is almost 10 years old, it provides strong utility to the world beyond as an investment, which drives demand. Over time, next to zero Bitcoin will be issued, but the aim is for the network to be so big by then that all contributors get paid a sufficient amount via transaction fees, just like Visa or MasterCard. Instead of comparing cryptos to gold, I like to think crypto assets can be likened to silicon. They have come upon the scene due to the rise of technology, and their use cases will grow and change as technology evolves. Currently, Bitcoin is the most straightforward, with its use case being that of a decentralized global economy. Ether is more flexible, as developers use it for computational gas within a decentralized world computer. Then there are the trading markets, which are trading 24/7, 365 days of the year. These global and eternally open markets also differentiate crypto assets from other assets discussed herein. In short, the use cases for crypto assets are more dynamic than any pre-existing asset class. Furthermore, since they're brought into the world and then controlled by open source software, the ability for crypto assets to evolve is unbounded. By the way, if anyone compares Bitcoin to tulips, tulips are not durable, not scarce, not programmable, not fungible, not verifiable, not divisible, and hard to transfer. But, tell me more about your analogy. One of the keys to supporting Bitcoin's value was its issuance model. Recall that miners, the people running the computers building Bitcoin's blockchain, are paid each time they append a block of transactions. They are paid in new Bitcoin created by a coin-based transaction, which has no relation to the site, that is included in each block. For the first 4 years of Bitcoin's life, a coin-based transaction would issue 50 Bitcoin to the lucky miner. The difficulty of this proof-of-work process was recalibrated automatically every 2 weeks with the goal of keeping the amount of time between blocks at an average of 10 minutes. In other words, 50 new Bitcoin were released every 10 minutes, and the degree of difficulty was increased or decreased by the Bitcoin software to keep that output time frame intact. In the first year of Bitcoin running, 300 Bitcoin were released per hour, 60 minutes, 10 minutes per block, 50 Bitcoin released per block, 7,200 Bitcoin per day, and 2.6 million Bitcoin per year. Based on our evolutionary past, a key driver for humans to recognize something as valuable is its scarcity. Satoshi knew that he couldn't issue Bitcoin at a rate of 2.6 million per year forever, because eventually it would end up with no scarcity value. Therefore, he decided that every 210,000 blocks, which at one block per 10 minutes takes 4 years, his program would cut in half the amount of Bitcoin issuing in Coinbase transactions. This event is known as block reward halving, or halving for short. On November 28th, 2012, the first halving of the block reward from 50 Bitcoin to 25 Bitcoin happened, and the second halving from 25 Bitcoin to 12.5 Bitcoin occurred on July 9th, 2016. The third will happen 4 years from that date in July 2020. Thus far, this has made Bitcoin's supply schedule look somewhat linear. However, when we step back and take a longer-term perspective, Bitcoin's supply trajectory looks anything but linear, as seen in this graph. In fact, by the end of the 2020s, it will approach a horizontal asymptote, with annual supply inflation less than 0.5%. In other words, Satoshi rewarded early adopters with the most new Bitcoin to get sufficient support, and in so doing created a big enough base of monetary liquidity for the network to use. He understood that if Bitcoin was a success over time, its dollar value would increase, and therefore he could decrease the rate of issuance while still rewarding its supporters. Long term, the thinking is that Bitcoin will become so entrenched within the global economy that new Bitcoin will not need to be issued to continue to gain support. At that point, miners will be compensated for processing transactions and securing the network through fees on high transaction volumes. As we mentioned, the Bitcoin supply will max out at 21 million units by 2140. This is a function of continuing to divide the units of supply released by a factor of 2 every 4 years. As of July 1st, 2018, already 80.1% of Bitcoin supply had been brought into existence. And by the next time the block reward halving happens in 2020, 87.5% of all the Bitcoin ever to be mined will be in existence. Also consider that an estimated 25 to 30% of existing Bitcoin are quote-unquote lost, meaning effectively no one has the means to access them because the private key is no longer known. A good example is the guy who accidentally threw away his hard drive with 7,500 Bitcoin on it. Those Bitcoins are still out there, but he can't access them, and neither can you because the private key is on that lost hard drive. With today's computational power, guessing a Bitcoin private key would take longer than the universe has been in existence. So effectively, it's impossible. So it's Bitcoin's scarce supply schedule that makes many think of it as digital gold. So let's dive a little bit more into the value aspect. Crypto assets have two drivers of their basis of value: utility and speculative. Digital units of Bitcoin don't exist beyond unspent transaction outputs or credits in Bitcoin's blockchain. Therefore, a significant portion of the basis of value is what the underlying blockchain enables the users of the assets to do. In other words, Bitcoin's utility value. Utility value refers to what the underlying blockchain is used for, and therefore what the demand is for its asset. For example, Bitcoin's blockchain is used to transact Bitcoin, and therefore much of the value is driven by demand to use Bitcoin as a means of exchange. Additionally, Bitcoin can be used as a store of value, so a percentage of the Bitcoin outstanding is demanded for that use case. All of these use cases temporarily bind Bitcoin, drawing it out of the supply of Bitcoin outstanding. The more that people want to use Bitcoin, the more they'll have to pay to get access to it. On top of utility value, there's a speculative value of a crypto asset. Since crypto assets are all under a decade old, much is still left to be seen regarding how each will develop, which is where speculative value comes into play. Speculative value is driven by people trying to predict how widely used a particular crypto asset will be in the future. With crypto assets, much of the speculative value can be derived from the development team. People will have more faith that a crypto asset will be widely adopted if it is crafted by a talented and focused development team. Furthermore, if the development team has a grand vision for the widespread use of that crypto asset, then that can increase the speculative value of the asset. As each crypto asset matures, it will converge on its utility value. Right now, Bitcoin is the furthest along the transition from speculative price support to utility price support because it has been around the longest and people are using it regularly for its intended utility use cases. For example, as I was making this video, $1.3 million of Bitcoin was transacted every minute, or $23,000 per second, which creates real demand for the utility of the asset beyond its trading demand. Now, what truly compounds what we've covered and why Bitcoin and cryptocurrencies have exploded in value recently are the 4 words which define this paradigm shift and why crypto assets are a completely new asset class. Limited supply, unlimited demand. These 4 words are critical to understanding why cryptocurrencies will continue to rise. When people think of things that are digital, they think of them as ephemeral, not limited. That's what Bitcoin did. Bitcoin's great invention, one of them, was that it made something that was natively digital, inherently digital, and made it property. It did that by the orchestration of technologies, namely the blockchain, and the result is that something that is digital can now be limited, have counterfeit protection, and act as property. Because it is the first piece of digital property, you can think of it as the first piece of digital real estate or digital beachfront. And when people realized that there will only ever be 21 million Bitcoins, they wanted a piece of that property. Remember that every other digital asset that has existed by its nature has been able to be replicated. Instead of having to sell and distribute CDs, an artist can instantly have their song in front of millions who listen digitally. The song can be copied over and over, allowing for maximum distribution. However, the song can also be copied illegally, much to the chagrin of record companies. Bitcoin and cryptocurrencies are the first digital assets which cannot be copied, allowing them to act as property. Something digital can now be limited. As we covered, limited supply, unlimited demand defines cryptocurrencies. We should also use this opportunity to define an economic principle known as the scarcity principle. The scarcity principle defines a situation in which limited supply of a good, coupled with high demand for that good, results in a mismatch between the desired supply and the demand equilibrium. The scarcity principle suggests the price for a scarce good should rise until an equilibrium is reached between supply and demand. That being said, when we factor in the scarcity principle in social psychology, we have a better understanding as to why Bitcoin and cryptocurrencies continue to rise. Consumers place higher value on goods that are scarce than on goods that are abundant. Psychologists note that when a good or service is perceived to be scarce, people want it more. Consider how many times you've seen an advertisement stating, limited quantity in supply, limited time offer, liquidation sale, only a few items left in stock, etc. The feigned scarcity causes a surge in demand for the commodity. The thought that people want something they cannot have drives them to desire the object even more. In other words, if something is not scarce, then it's not desired or valued that much. Also consider that most estimates put there to be about 15 to 30 million millionaires in the world. And consider that if each and every one of them wanted a Bitcoin, there's only about 12 million Bitcoins available once you factor in those that are lost. So not every millionaire could have their own Bitcoin. As we said, Bitcoin is the first digital beachfront, and the more and more people want one, the price will continue to rise. Limited supply, unlimited demand. So guys, thank you very much for watching. If you enjoyed the video, please hit the like button. And if you're new here, please hit that subscribe button so you can continue to see high quality crypto analysis. And don't forget to hit the bell next to the subscribe button to be notified when we put out new videos. Additionally, check out the description for a link to our daily newsletter. Thanks again for watching, guys. I'll catch you in the next one. Cheers.